Welcome back to the Consumer Advice Series. This is the About Mansfield podcast page. We appreciate you being here live on Facebook. And this is now the second of three today that we are doing. We heard from Dr. Joseph Adams earlier today regarding migraines. Currently, right now, we're going to be talking about wealth building with Phillip Washington Jr. And then coming up today at noon, so just about an hour from now, because it is January, we are going to be talking about taxes, and Adam Cohen will be here a little bit later on to take on that subject. So here in the studio today, some of my guests will be on Zoom. Some of my guests will be here in the studio. So in the studio today, he's over here on my shoulder, just over my left shoulder, is Phillip Washington Jr. By the way, this episode is brought to you by Stonehill Wealth Management, and we welcome Phillip Washington Jr., welcome to the About Mansfield Consumer Advice Series.
Thanks for having me.
Absolutely. And let's get into, first of all, because this is the first of our series together, let's introduce yourself. What is your background, and why are you qualified to be a wealth manager?
That's a good question. What qualifies anybody? So I am the founder and chief investment officer of Stonehill Wealth Management. So since it's my company, I get to be the wealth manager. Benefits of owning the company.
Which makes you qualified.
Which makes me qualified. And I'm also the host of Wealth Building Made Simple podcast on every major platform. And I've been in the industry for 16 years now. So
which happens to be recorded and produced right here at Podcast Mansfield Recording Studio.
The best recording studio in the world now. We moved from Texas to the U.S. to the world now.
Nice.
Yeah.
Nice. So. All right, so this is let's get into it. It's topsy-turvy financial market lately. The question, should I buy? Should I sell? Should I just liquidate everything and move to Puerto Rico? Why is the market falling so much?
Yeah, so on the podcast episode we just recorded for Wealth Building Made Simple, that's releasing later on today, I went into the different factors that impact return, and one of the factors being money supply. So all things being equal, money supply affects returns. And so what began happening late last year, fall last year, was money began to tighten. And then the Fed followed through and said, "Hey, we're going to tighten money." And what does tighten money mean? They are going to begin to suck money out of the system. And to keep things simple, I won't go into how that happens because that will be a whole brain drain. Again, Wealth Building Made Simple, I go into all that a lot. But they're pulling money out of the system, and they're telegraphing to the market, we plan to continue to pull money out of the system. And so that causes asset prices to go down. Again, all other things being equal. People might say, why would they do that? Well, when they're worried about inflation, consumer price inflation, they want to put out the fire, which means they begin taking money out of the system so people can stop speculating on, assets, different goods and services, things that are causing the inflation.
Sure. And so what happens if the feds don't stop the money supply?
Yeah, so here's the interesting part about our financial system. Let's say they never support it, right? Then you can pretty much talk to anybody who understands economics and everything well, and literally the system will blow up, because if you look at what the system is built on, which is debt, you have big companies and small companies that have borrowed money based on collateral. So let's use simple math. Let's say your business is worth $1 million. Let's say the bank allowed you to borrow $500,000 against your $1 million business, but and they have a minimum required of collateral you have to have in order to keep the loan open. So let's say your business value drops to some number that drops you below. Let's say it drops to 500,000. Just making up a number. Then they say, okay, listen, you no longer have collateral to set the, to support the loan, and so we need you to put up more collateral, right? But everything else on your balance sheet went down too, and you don't have a lot of cash, right? Because the system is built, people don't have a lot of cash when it's not earning much, and they use debt to grow, and so that kind of trickles, right? Because then any cash you do have, you have to sell assets to convert it to cash, which further drops asset prices, and it's like a domino effect in the whole system. And so eventually people aren't able to pay back their loans. They file bankruptcy, they lay off people, and it just, the system literally like blows up. And this is like around the world. This is not even factoring the derivatives that we have, the um, um, all these other different created contracts that have a lot of embedded leverage. These are the entitlements factor this, things that the benefits we promised people. There's a shortage of dollars in the system because real money is credit, and there's way too much credit. And so if they don't support it, the system blows up.
How do investors protect themselves?
Good question.
That's why I'm the host.
Yeah. So I'm a huge believer in diversification, and again, referring back to the podcast we recorded today earlier, I talk about the time-tested way, right? I like to look at time-tested wisdom that was not given by a guru of this age. I like to look at gurus of multiple ages and wisdom that goes through and is truthful, not just a decade ago, but 100 years ago, 200 years ago, 500 years ago, 1,000 years ago. The further back I can go and find useful advice, the better. So, one of the old school Ecclesiastes 11:7 from the Bible, a very old text. It says, spread your money in 7 different places, maybe 8. You never know what calamity might come upon the land. So diversification is the one place that you could do to protect and grow your money. And I talk about 4 buckets of assets you can invest your money into, and I won't go into that. It's on my episode, the Wealth Building Made Simple podcast episode. But one bucket specifically is a bucket that we use for if a system blows up, right? So if you look at when the dollar system, changed from the system we set up in 1945, Bretton Woods, to 1971 when we delinked money from gold, and we had the 70s inflation. That was an inflationary bust. When that system blew up and a new system emerged, and when the system was blowing up, gold, like stocks didn't do well, bonds didn't do well. If you had cash, you lost purchasing power relative to things you wanted to purchase. So that wasn't a good look. Really, the only thing that did well in that period was gold, because gold is a fixed, scarce asset that's for thousands of years been what people move their money to when a currency blows up, and currencies historically always blow up. You fast forward to today, so you say, okay, how do I protect my money? Well, you want to have in your portfolio something like gold or gold, right? So gold is cool. It's historically good. But this is why you have the millennials and the tech generation saying, oh, okay, now what's better than gold? Bitcoin, a scarce asset that is a part of the portfolio, because what we learned in the past about gold was they can confiscate your gold. If the government wants to keep the Ponzi scheme going, they can confiscate your gold. And if you have $100 million worth of gold, it's really hard to keep that protected. But if you have $100 million worth of Bitcoin, you can keep that protected in your head or on a small device. And so
$100 million of gold, you need a pretty big shed.
You need a huge, very big shed. Side note, that's how Wells Fargo built their business, transporting gold from the, to the West.
Yeah.
For people. But I digress. But yeah, so gold, Bitcoin, those are really good assets to protect your money. And it depends on your risk tolerance, right? Because gold is less volatile than Bitcoin. So if you want to try to make a lot of money, potential money, if this were the case, right? Gold, the more Bitcoin you own, the better the potential return, right? Nothing's guaranteed, right? But diversification works, and these are asset classes that are insurance from a inflationary bust, which is a possibility, but I don't think they're going to allow it to happen.
So, in a nutshell, diversity is good.
Diversification is the most amazing invention for investing ever invented.
If anyone had any questions about investing or really how to get started, if you're young, I've got some dollars to invest. If someone has some questions about your service at Stonehill Wealth Management, how can they get a hold of you?
The best way is just to go to stonehillwealthmanagement.com. That's stonehillwealthmanagement.com. From there, you can access all the information about our company. You can access the podcast. You can book a time for a consultation, stonehillwealthmanagement.com.
Phillip Washington Jr., he is a wealth advisor. This is the first of many, many, many consumer advice series episodes that he and I are going to be doing together every Friday, streaming live on Facebook. If you missed the stream, you can watch it here on Facebook. You can go to YouTube. You can go to LinkedIn. If you want to hear just the audio version, these episodes will be released as podcasts. Phillip, have a great weekend, and we'll see you next Friday.
See you next Friday. Thanks.